Good morning. A little bit of a rebound today after we finished in the green yesterday. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Coming up, another report that Trump's economic team is considering a gradual approach to the tariff hikes. The dollar dips on that Bloomberg scoop. The latest word on tariffs comes as traders digest today's PPI data and brace for big swings tied to tomorrow's CPI report. Also, as we kick off earnings season. Plus, a shakeup at J.P. Morgan. The bank names Jennifer Piepszak as its new chief operating officer, replacing Daniel Pinto, who will retire at the end of 2026. First off, let's take a look at where markets are trading. Yesterday, we actually climbed up and finished in the green. Right now, we're looking at another gain for S&P futures, about 0.4%. As we kick off earnings season, NASDAQ futures up a little bit more than 0.5% right now. And the 10-year yield, although it's climbing a bit, it is still holding at the same level we saw roughly yesterday, 478, to lend your money to the U.S. government for 10 years. Sonali, what are the stocks that we're watching today? I know there's some deal news.
Yeah, there sure is. We're looking at H&E Equipment Services first, though, because it is soaring after United Rentals agreed to buy it for $3.4 billion in cash and expand its fleet of construction equipment. You do see this now doubling to $90 a share pre-market. Just incredible here. Deal flow just keeps coming into 2025. Also watching KB Home up more than 13%. It reported revenue and deliveries for the fourth quarter that beat estimates. We are in earnings season in addition to the deal season, apparently. And Signet is plummeting because the owner of Kay Jewelers cut its fourth quarter sales forecast, citing consumers who opted for lower price points this holiday season. We have already been seeing hints of that, Matt. And now let's see how much that continues into this earnings season.
Yeah, the consumer is a big question. Actually, the NFIB, the National Federation of Independent Businesses, monthly small business optimism index jumped to the highest level since 2018. It's almost back to the level that we saw this month 8 years ago, before Donald Trump took office the first time. NFIB chief economist Bill Dunkelberg said expectations for economic growth and lower inflation and positive business conditions have increased in anticipation of pro-business policies. But Renaissance macroeconomist Neil Dutta says an important distinction between now and 8 years ago is that the consumer doesn't appear to be confirming the move in small business sentiment. In December, consumer expectations slid to a 5-month low. And of course, given the recent sell-off in equities, the backup in rates, and the higher price of oil, it's unlikely that the consumer is going to come out swinging to kick off 2025.
Right. If you think that the 10-year rate of almost 5% is high, you're a consumer with a credit card rate of more than 25%. That's really high. And so when we think about big bank earnings season, we're going to be thinking about whether you're seeing those delinquencies rising and the consumer actually weakening. It is a busy season. There's political news. Of course, the confirmation hearing started. There's a lot of rumors around how the Trump administration will deal with everything from TikTok to tariffs. What are you watching?
Yeah, I mean, all of that stuff makes it a very busy day. Of course, we also got PPI, producer price inflation data this morning. It did come in below estimates. We want to break down the reading with Bloomberg's Michael McKee. He's going to look into the details for us. So, Mike, what do we see?
Well, we see some good news for the warm-up act for tomorrow's CPI, I guess, with the PPI headline coming in at half what was anticipated, just up 0.2 during the month. That puts the year-over-year at 3.3%. Also, slow growth in the core and the core ex-trade. They are up 3.5% and 3.3%, better than expected in both cases. So the markets are relatively happy. What did it? Well, a decline in food prices was one of the reasons that we saw prices restrained in the PPI. Overall, down 0.1%. But look at this. Donald Trump said he was elected to bring down egg prices. They had gone up 55% in November. That really is because of the bird flu, not because of any Biden administration policies. But look what happened in December. They were up only 3%. Joe Biden goes out on a high note. Tomorrow, though, is what everybody is waiting for. That's the big show, the CPI. And the CPI is expected to also show a little bit of a rise, not as much as was expected for the PPI, but maybe this is good news in the long run. The thing about the CPI is it's shown this seasonal pattern. You remember last year, we saw CPI prices, the CPI index rise into the end of the year, and the Fed stopped its plans to cut rates at that time because they were worried about inflation taking off again. Same pattern seems to be in place this year. Do we see that continue or not? That's going to be the real question tomorrow.
We're at the part of the cycle where I feel like you really have to break it down into components now, even too. I was looking at Cameron Christ. I love how he put this. Once bitten, twice shy could be the reason we didn't see that bond market reaction for the modest data today, even with services inflation showing some optimism there. What do you make of that? Where should investors be looking in terms of the component pieces tomorrow?
Well, tomorrow you want to look at the usual suspects, but particularly housing, also airlines. Airline fares up big in the PPI, and used cars are expected to decline or to post just a small increase after a bigger increase last month. But it's the PCE that the Fed moves on, and some of the components in here were pretty good. Portfolio management up just 0.2%. Now, that's what has driven a lot of PPI inflation that goes into the PCE number. And that'll be interesting to compare with you tomorrow. Bonus season and bank earnings. We'll see how much of that PCE number is going to be accurately reflected when you and I fight for airtime tomorrow between me and the CPI and you and the bank earnings.
Does that count as labor costs when we talk about banker bonuses?
Well, for some.
Yeah. For some,
Select
yeah.
few.
All right,
Until the robots take over.
Mike McKee, we will spotlight CPI with you tomorrow. It's not all about bank earnings, although it's like Sonali's Super Bowl. Wells Fargo Investment Institute head of global market strategy, Paul Christopher, joins us now to talk about what's going on in these markets. And Paul, I got to say, last week on Friday, going into the weekend, it felt really troubling after the good news that we saw in the jobs market. The spike in rates and the fears about inflation seemed to come to a head, and I thought the market was really at a turning point. Did you feel that, too, in terms of the equity indexes turning down?
Well, I mean, the markets got this way in December, too, around the inflation report and then the subsequent Fed meeting. And it seems like every time the markets get a little bit disappointed in terms of Fed rate cuts, we see some selling, but then the trend resumes. So, no, wasn't really bummed out about Friday. It looks like a buying opportunity to us because you've got a tight labor market, one that's normalizing but still tight, and that drives services. And services will drive wages, and wages will ultimately drive inflation. So our inflation forecast at 3.3%, we think stocks like that for 2025, and so we're looking to buy here.
How do you bring in kind of the uncertainty here around tariff strategy? Because ultimately there is still a concern about what kind of inflationary impact that could cause. Where do you stand?
Yeah, that's a big unknown, but you have to take the whole picture. So first of all, the whole policy picture is tariffs are negative, yes. Immigration restrictions are negative for the economy and markets. Yes, that's also true. But then you've got deregulation and probably, we think, very probably, an extension of the 2017 tax cuts. And both of those are positive. So how do you know which one is larger? Well, maybe we don't know yet because we haven't seen all the details. This morning's hint that he's going to phase in tariffs, that would be a very positive factor. But then go to an even bigger picture where you put those policy unknowns against an economy we think is still pretty strong. Consumers may not have finished the year as strongly as we would like, or coming into the year as strongly as we would like, but we think they will drive the economy this year. So will the policy uncertainties be enough to derail that economy? We think, all things taken together, no.
I was reading a Neil Dutta note earlier, his concerns about the consumer with falling stocks, rising rates, higher oil prices. Sonali brings up the point that, there's so much credit card debt, and a lot of that is over 25% interest. I know auto loans that I look at all the time are double digits. Isn't the consumer going to face a lot of headwinds this year?
Consumers have been facing headwinds now for a couple of years, and that was one thing we got wrong in 23 was looking too hard at some of that aggregate data and not breaking it down a little bit more into quintiles. If you look at the lowest two quintiles, yeah, they've been holding their breath underwater now for a couple of years since 22, 23. But the upper quintiles, the upper income quintiles, have done much better, and especially that top quintile that especially can gain from higher stock prices. So they can turn those gains into spending, and that's helping to drive the economy. So you've got this real divergence going on. You can see the same thing between small businesses and larger businesses, and the larger businesses have been driving things. So we do like large cap stocks here, and we do like the consumer overall to continue driving things.
So if you're concerned about kind of the bottom two quintiles in terms of wealth and income in the United States and their ability to draw consumer spending, then what about kind of the second to top? I think a lot of investors are looking around and saying, when does the pain start to spread in terms of the way the consumer is able to put that extra dollar to work?
Yeah, that's a good question, too. So, if you start moving down the income quintiles from the top towards the bottom, the one, let's say the second one from the top, or the one right next to the top, that's one where you still have wage gains that are in that 3 to 4% range. And if inflation can stay between 3 and 3.5%, well, then you're basically netting out a positive gain in purchasing power every year, or and on a monthly basis too, for those consumers. And then you go down another quintile, and they get the same benefit, the same tailwind. So it's really those consumers on the bottom who've overborrowed. Maybe they're close to delinquency. Maybe they're having trouble making even the minimum payments, and sympathies to them. But in terms of the overall economy, it's those other quintiles that are going to really drive things by either wage growth over inflation or with capital gains that turn into spending.
Hey, I'm looking at your top 5 portfolio ideas for 2025. Your cross assets, so it's not just stocks, right? Prepare for abundant liquidity. You point out position for a cyclical economy, but remain tilted towards the U.S. Expand opportunities in AI. Be careful of extreme risk. But one that I think is really interesting, rethink investment income. What do you mean by that? Is that just taking advantage of these higher rates?
Yeah, well, that's a big part of it. Investors have really become accustomed to what I might call the comfort food of income, which is to go to CDs, to go to short-term treasuries, and especially money markets. Money market funds aggregates are huge. They're off the historical charts. But that's kind of comfort food because you don't see a lot of risk in those, and you get that 4 or 5% rate that you've been longing for many years now. But that rate we don't think is going to hold up as well. It's not going to rise as much as what we're going to see in your ability to lock in those long-term rates here. So you lock in long-term rates that investors haven't seen for years and years, maybe even more than 15 years. You lock in those rates now, maybe doing some dollar cost averaging, a little bit at a time each month as rates gradually move higher. And then you add to that from the equity side. As long as rates don't get much above 5%, and we don't think they will, then we think dividends will become, and it will remain, an important source of not only income, but income growth for investors. So put those two together and kind of put that comfort food aside.
Wells Fargo Investment Institute Head of Global Market Strategy, Paul Christopher, we thank you so very much for breaking down the complications of this market. Coming up, there has been an extraordinary amount of movement on Wall Street at the top levels. JP Morgan's COO Daniel Pinto announces his retirement. We're going to discuss his replacement and what it means for Jamie Dimon's succession plans. JP Morgan reacting to the market, Matt. Stick with us. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Hot, dry winds are pummeling Los Angeles and areas of Southern California. Still, a new blaze broke out in Ventura County overnight, but authorities managed to keep that fire from growing. Crews are struggling to contain the flames in Los Angeles that have killed at least 24 people. Wind gusts now expected to be as high as 75 miles per hour. Those blazes have scorched 40,000 acres and continue. Some of TikTok's 170 million users in the U.S. are flocking to 2 other Chinese social media apps. Little Red Book is one, Lemon 8 is another. The apps have taken over the top 2 positions on Apple's App Store download charts in the U.S. ahead of an impending ban on TikTok here. The hashtag TikTok refugee has garnered over 44 million views. And NVIDIA CEO Jensen Huang is embarking on a trip to China this week. He's visiting major cities at a time when Beijing is investigating his company's domestic presence, and Washington puts new curbs on NVIDIA's AI chip exports. It's unclear if he'll be meeting with Chinese officials during the trip. NVIDIA has declined to comment. And Ares has amassed around 30 billion euros of capital for its latest direct lending fund in Europe. The new fund is the largest of its kind in the region. In fact, Ares has secured the highest level of investor demand for any private credit fund on record, according to a statement seen by Bloomberg. Sonali?
We're going to go over to some of the biggest news on Wall Street this year so far. It's early yet, but JP Morgan's longtime COO, Daniel Pinto, very responsible for a lot of the big gains they've made in the trading and investment banking division, announces that he will retire at the end of 2026. Jennifer Pipsack will replace him, but when it comes to planning for Jamie Dimon's succession, she said, according to a spokesman, that she isn't interested in the CEO role for now. Anyways, Bloomberg senior finance reporter Sridhar Najarian joins us. The for now, I'm hung up on that. You have Joe Evangelista, who's of course, the spokesman for JP Morgan, saying she's not interested, hold the horses, and an announcement with a lot of pomp and circumstance otherwise. Clearly, everyone's looking at succession planning at JP Morgan. Jamie Dimon has stopped saying 5 years, at least for now. So what does this mean in terms of the new guard rising?
If Joe's statement had ended at she's not interested in being CEO, it would have been much clearer for us, and the clarity would have been nothing's clear atop JP Morgan. But by also adding this clause about for
at
now,
this time,
we don't know at this time. We don't know whether that means in 6 months when Daniel Pinto steps down from his role as both president and CEO, at least those titles, when he relinquishes those titles, will Jen Pipsack be more interested then? But let's take it at face value right now.
Right.
We should take it at face value right now, and the clear signal they're trying to send is, even though with the slew of changes that they've made today, there's various executive moves that we're seeing at JP Morgan today, Jen Pipsack's clearly saying, I don't want to be successor to Jamie Dimon. So who will be the successor to Jamie Dimon? The hit by the bus candidate, Daniel Pinto, is leaving end of next year. Marianne Lake, another likely candidate, at least in today's announcement, nothing's changing with her role, nothing's changing with Mary Erdos's role. So we really don't have clarity at that front. So only thing you can perhaps say with certainty is Jamie Dimon isn't going anywhere anytime soon.
Well,
for now.
Right, he's not stepping down in 6 months.
No, of course not. And he appears to be in great shape. Investors hang on every word out of his mouth. He's unquestionably the king of Wall Street. But he is turning 69 in March. Wouldn't it be in the best interest of his shareholders for him to lay out a clear succession plan?
And I think JP Morgan will argue that a number of changes that they've made, not just today, but going back the last couple of years, are all aimed towards getting that right. But when you have one of the leading candidates saying, I'm not really interested in being CEO, it doesn't really make Jamie's job easier. And also remember, I think Jamie Dimon is probably having a lot of fun on top. I don't think he's in a rush to leave the stage. And I think till you don't have clarity below him, till you're not certain who can actually take on that mantle. You say King of Wall Street, but definitely, most certainly, Dean of Banking. Until you're not certain who can step into those shoes, I think it makes more sense for JP Morgan, for Jamie Dimon to stick around a little while longer.
Well, let's kind of take a Goldman playbook for a minute for JP Morgan. Typically, you want to have a few seats warm, right? Just in case one leaves, you want to put people in competition with each other, because what's a good succession without a good fight? And so if you're not looking at just Jennifer Pipsack, who else are you looking at JP Morgan? Because she has been elevated so fast that you wonder if she's the only real candidate now.
And that's what we would have said, and that's what I would have said before I read Joe's statement, because when you read the announcement today, it's clear that there's only one clear winner, only one person getting a real big promotion, because Daniel Pinto is the second most important executive at JP Morgan, the largest bank in the country. So Jen Pipsack, for all measures, was clearly the biggest winner coming out of this announcement, at least not the big winner from the perspective we care about as to whether we can call her the anointed successor, because she's rushing to say she's not interested in being CEO. And the other interesting thing to me is she's taking on the COO title, not the president title. So when Pinto relinquishes that title in June, I'm interested in seeing who gets that. Do they also give that title to Jen Pipsack, or do they elevate someone else to be the president or co-presidents? Because then we're talking the Morgan Stanley model. Why do I bring up Morgan Stanley? Because that's the next biggest bank most recent bank to have gone through a succession like that. At the time, they had a COO, John Truzan, and 2 co-presidents. It was one of those 2 co-presidents, Ted Pick, who eventually became the CEO, not the COO. So you could get more clues down the road.
And Morgan Stanley, a textbook case for a succession run well,
James
right?
Gorman now running that at Disney, too. That well.
All right, awesome. I have a feeling we're going to hear more from you in the next couple of days, Sri, as we kick off bank earnings. Thanks very much. Sridhar Natarajan covers the banks for us here at Bloomberg. Tune in to our exclusive conversation, by the way, with Daniel Pinto from Davos. That's next Wednesday at 6 a.m. Eastern. This is Bloomberg.
There's a lot going on today. Markets trying to rebound after that PPI data, and of course ahead of CPI tomorrow, and of course bank earnings as well. S&P futures hanging below 6,000 all year, man. It is now. It's painful to watch, actually, but it's up 0.5%. There's other things going on as well.
There's a lot going on today. We have Pete Hegseth's confirmation hearing, and we've already heard not only his opening statements, but some senators, including Jack Reed, saying, this is a direct quote, "I do not believe that you are qualified." So that's probably a statement you're going to hear from quite a few senators today.
Yeah, but it really comes down to what certain Republican senators feel, particularly Joni Ernst. That is going to be one a lot of people are watching out for. Of course, this is another test of the slim Republican majority that you're looking at in Congress, and even their inability to agree over some of the most critical posts in this country.
Yeah, we are going to hear from Anne Marie Hordern in about an hour as this hearing progresses, so we'll get you up to date on Pete Hegseth's confirmation hearing to become the Secretary of Defense for the United States of America. Up next, Racquel Oden joins us from HSBC. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We do see futures up this morning after the equity market gained yesterday at the close. S&P futures right now up about 0.5%. NASDAQ futures up a little more. Kicking off earnings season, we're going to see about $3 trillion worth of companies reporting this week. In 2 weeks, there's going to be a $22 trillion week. So it gets a lot busier than this, but the banks really kick it off tomorrow, and Sonali is going to be all over that. You see the opening bell down at the NASDAQ market. I believe we're going to see somewhere, aren't we going to see the ETF group ringing the bell? Defiance, yes, at the NASDAQ market site. Looking for Sylvia Jablonski there. I know she's going to ring the opening bell. Creative Spirit ringing the bell at the New York Stock Exchange. Looks like a slow news day when you check this out, but actually there's a ton going on with the report out by Bloomberg News that Donald Trump is going to gradually bring tariffs in. This is only his advisors who have crafted this plan, according to people familiar. They haven't told him yet. We'll see how he responds on Truth Social. In terms of the stocks to watch this morning, there's been some deals. H&E Equipment soaring after United Rentals agreed to buy it for $3.4 billion in cash and further expand its fleet of construction equipment. That adds to the $15 billion deal we saw from J&J yesterday. And Sonali, we have some actual reporting out in terms of earnings.
We sure do, but I've got to say, the only thing I love more than a deal is an all-cash deal. There's nothing better than that. That's
like
certainty on the table. Anyways, KB Home, speaking of earnings, up 11% as the market opens. They reported revenue and deliveries for the fourth quarter. That beat estimates. Analysts say that the beat was driven in large part by cost-cutting, buybacks, and a lower tax rate. Also watching Signet, it's plummeting after the owner of Kay Jewelers cut its fourth quarter sales forecast. They cited consumers who opted for lower price points this holiday season. Signet down now about 16% nearly as the market opens. People are worried about the consumer. And as we think about the consumer, companies worth more than $7 trillion are reporting earnings this week and next. We're going to take a deeper look with Bloomberg's Zenitsa Seikova. What are you looking out for, particularly what we know now about that consumer?
Yeah, I think this week the biggest thing will be banks. And obviously Wednesday is a banks earning bonanza. We have some of the biggest names reporting. There are a lot of catalysts this season. We have revival in deal making, we have share buybacks, we have revenue growth. So there is definitely so much optimism. Obviously, the incoming presidency is a big boost to banks. We've seen it in banks' reactions so far. Obviously, everyone's excited about deregulation, about friendlier tax policies. So we've seen that top in front of mind of analysts. Barclays is very bullish on that. That said, we saw Jefferies reporting, and so far it's been a disappointment. So that's one reason perhaps some on Wall Street are worried about the banking earnings. We've seen some positive news. We saw a glimpse of Citigroup and JP Morgan trading. Seems like things are looking very good in terms of profitability. So Jefferies, obviously what we saw is like disappointment in margin expansion and investment banking revenue. So perhaps that's something a lot of people will be looking at. But of course, incoming presidency, big boost to banks. So that's top in front of them.
Yeah, and higher rates maybe helps them as well. Did we show the market cap chart yet? Did we show the market cap chart yet? Because I think it's striking. Okay, $3 trillion this week, $4.3 trillion worth of companies reporting next week. But in 3 weeks, here you go. Look at that, $22.4 trillion.
Those are your big tech companies.
Worth of companies. I mean, it's just unbelievable that market cap like that exists, and it's not the entire market, right? I guess Nvidia is going to be there, Apple's going to be there. All of the Mag 7 can move that needle. But what do we expect?
Yeah, for sure. So we're seeing a lot of volatility in market, which I think we have to feature in. Even when it comes to banks' earnings, obviously now we're pricing close to 1 or 0 rate cuts next year. So all that bullish sentiment towards banks, of course, is dependent on that. When we talk about all those big tech names, we're worried about valuations. They're very hard, they're elevated, and when yields are approaching 5%, investors think about them differently. And perhaps they may not be as nice when they react to earnings surprises. We have Netflix next week. It seems obviously it had a really big rally last year. Wells Fargo is very bullish, still overweight, so valuations are not necessarily a problem. American Airlines had a tough year last year, but we're seeing optimism about it next year. We see so many price upgrades. So for now, volatility in markets hasn't translated into much worry, but we're yet to see.
Bloomberg's Zenitsa Seikova, we thank you for keeping an eye out on all of this. Of course, you saw the VIX over 20 yesterday.
Yes, I did.
Volatility seeping into the markets even before earnings really get started. We are now going to bring in Racquel Oden of HSBC to broaden out the conversation. She's U.S. head of international wealth and private banking. People have been so beholden to big tech, particularly because they've accounted for most of the gains. Every sense of the broadening trade that we've seen has faced pushback, particularly when you've seen rates still edge higher on the long end. Where's the optimism outside of big tech?
That's great. So I would say what we've been sharing with our clients is we talk about the Santa Claus rally that we're expecting for the fourth quarter. That did not happen. So that has caused a little bit of angst, in the markets. But what we've told people is even with the Fed rate cuts, which we've just debated right now, maybe a little lower than we originally anticipated, we're still bullish on the equity markets. And to your point, when we take a look at the S&P overall and we look at corporate earnings, again, pretty strong. So we take this year, we ended at 9.4% in corporate earnings year over year. We're predicting about 14.8% in 2025. That's big. Slightly down from 15%. So
it's
to be
still
clear,
a lot, right?
It's still a lot.
You don't expect that bar to get lowered as we get further into the year?
So I don't believe the overall bar gets lowered, but to that point around the tech and the Mag 7, it is really the widening out. And I think you heard me share that the last time, right? We take a look at the Mag 7, about 23% up this year. We're probably predicting that to go down to close to 18%. The important part of that is the widening out of that sector, so the unforgotten 493 will start to rise. And that was about a 4% gain for those 493. We're predicting close to 15% for them this year. So it is still that tech sector, but it's the widening of the sector. As you just said, market caps are pretty high in many of those Mag 7s. So the opportunity for more to drive that, I'd like to compare this time period to the 90s in the same time period, which is that innovation tech evolution that's taken place. We went through that with the dot-com era in the 90s, and we really saw a lot of the same behaviors we're seeing today. What comes out of this is productivity drives profitability, which really drives growth. So we're really going to lean on the markets and the tech sector to really drive that. while at the same time we're not going to see that level of Fed cut rates that we originally talked about, but it's going to be less about that because it's really going to be the productivity and what I'd say profitability that's going to drive the market.
I mean, the problem with the 90s was we spent so much money to lay down fiber, right? The infrastructure of the internet, which we're all happy to use today, and it's very profitable 25 years later, was too expensive at the start, and we saw that bubble burst. Do you expect the same thing to happen to the AI bubble, if this is a bubble, the AI bubble right now?
So we're definitely not at the bubble yet. We're such at the early inning stages of AI, right? And so that's really where you're seeing all the companies that are now aligning to AI and figuring out how to use it. There's going to be lots of false starts, and there are going to be those that really hit it. So just like in the dot-com era, right? Not every dot-com, made it. You've got to pick the right winners. But you're right. We're going to be in a period of really figuring out how core corporates embrace AI as well as the tech sector. The beautiful thing about AI, it's way beyond tech. It's every sector embracing AI and figuring out how best it's going to help them drive productivity and profitability.
I also want to talk about a different sector now, banks, because we are starting banks.
She sure does want to talk about banks.
Listen, this is a trade. I want to pull up the KBW Bank Index, BKX. Take a look at it, because after November 5th, you did see a sharp leg higher in a lot of optimism that rules will be revised, lighter, but a lot of that has been wiped away if you take a look. And it's interesting, over 6 months, every stock in that index was in the green, and then you've seen, 5, 6 stocks start to turn negative in the last 3 months. Is the optimism fading? Are the gains already priced in?
So the gains are not priced in. I don't think the optimism is fading. I think the reality is, as we know, in January, you're always going to see this volatility, right? So let's just embrace volatility. But ultimately, if you look at the sector, there's indication that this administration coming in really has an impact on the sector. And so to me, it's kind of wait and see, because the administration can say a lot of things. The question is, will they do it? And the two things that are going to be a big catalyst, right? We all know deregulation, especially the Basel III, right? The ability for banks to not put that much money in reserves will absolutely hit profitability. You add to that corporate tax cuts, right? These are statements. So, like the market, you want to watch and see, will the administration do those things? And that's the reason why you're seeing a little pause or caution. But if they were to happen, those have not even been priced in, right? So that's the benefit. And I just told you about the strong corporate earnings, right? So if corporates are that strong, and you have this other piece, if the administration does what they say, there is the opportunity for banks to continue to do well. What we are all pausing for, though, is that use of how the administration is going to implement tariffs. That is an important piece, right?
And deportations.
And deportations, right? The two go together. So again, the administration is this unknown. Lots of statements made. What actually happens, we don't know. And I think we all are pricing it in and cautiously watching to see what happens. But all those indications make the bank sectors look really good.
I feel like, is it fair to say that nobody believes deportations are going to happen in size? Because everybody just neglects to mention it, but it was part of the campaign, and Tom Holder seems pretty serious about it.
There were a lot of things that were part of the campaign, and so that is my point, right? And the idea here is, one, the markets and the fundamentals, thankfully, are strong. If the administration steps in and does the things that they've talked about, there's possibilities that certain sectors would do very well. But again, it's a watch and see.
Right. All right, Racquel, great having you here with us in the studio. Thanks so much for coming in. Racquel Oden there from HSBC. Coming up, we'll talk about Elon Musk. Could he be the next owner of TikTok? More on that possibility for the social media app next. Plus, Pete Hegseth faces the Senate Armed Services Committee for his nomination to lead the Defense Department. You can watch the full hearing on your Bloomberg terminal. Just type Live Go, or for our blog, TLIV Go on the terminal. This is Bloomberg.
David Bellavia, who earned the Medal of Honor for heroic actions in combat in Fallujah, Iraq. David Bellavia writes the following: Pete is fearless, unflappable, and confronting.
Time now for top calls. Some of the analyst action that we're focusing on this morning. First up, Instacart is getting upgraded to a buy at BTIG. The firm sees signs of accelerating order growth. The analyst there also says the valuation for the online grocery delivery service is not particularly challenging. Next up is Las Vegas Sands, no longer a buy, according to Morgan Stanley. The analyst sees growth being tempered in most segments. The firm also says tariffs could weigh on its China business, Macau in particular. And finally, Bank America is cutting ag giant Archer Daniels to a sell. The firm says the profitability outlook has soured considerably over the past few months, given risks stemming from the U.S. election. Sonali?
Now to another Bloomberg scoop. TikTok owner ByteDance evaluating a potential option for the popular app's U.S. operations for TikTok. Sources say that one of them is selling to Elon Musk. For more on this story, we are joined by Bloomberg Technology co-host Caroline Hyde. Something I've been thinking about a lot is, okay, who would want this to happen? Because if you are China and you are frustrated with the U.S. and the back and forth on TikTok, would China want Musk to be buying it because they're already entangled?
China might, and I'm just going to correct some of the introduction to that, because it's not ByteDance that wants this. ByteDance wants the opposite. ByteDance does not want to be selling TikTok under any duress, and indeed they want to keep hold of it, probably just would ban it.
Well, and China doesn't want it. ByteDance to sell it either. This is just in case.
In case.
Yeah.
And this is the Chinese government, from Bloomberg sourcing, potentially trying to work out what are the scenarios that fall out if indeed the Supreme Court does stand by the current Congress law that this is going to be banned or sold. So China is thinking, there is an interesting person that we rather respect who has a lot of presence in China and is very close to the president-elect, one Elon Musk. Oh, goodness, he has his own social media company. Wow, he also has a really strong AI presence. He could benefit from owning this algorithm. And remember, China has such sway because even though they don't have ownership of ByteDance, even though, of course, TikTok's gone to great lengths to say that the Chinese government is a safe distance, they do have the ruling on if indeed an algorithm is sold abroad or exported. They could overrule that. So they have a sway on if US TikTok is indeed sold and who gets to buy them.
Well, I should say that there are reasons initially Donald Trump wanted to ban TikTok. In fact, he acted to ban TikTok, but that was overturned. And that Congress, both the Democrats and the Republicans, want to ban TikTok because they're worried China could use that algorithm to spread misinformation or stir up social unrest. They're worried that the Chinese could use that information, the data, to blackmail or intimidate Americans. And they're worried that China could use software updates, ByteDance, I'll say, and China in the same breath because it's China, could use software updates to sneak malware into our phones and computers.
National security risks.
Exactly.
Which at the moment are outweighing for the Supreme Court the right to free speech, which is actually Elon Musk is a big proponent of, and why back in April he put on his own social media platform X that he didn't want a TikTok to be sold because he thinks that speech should remain and free in the United States.
Well, I mean, you're a contributor to TikTok as well as Instagram, right? Yeah. You can say whatever you want. You just maybe can't say it on a Chinese platform.
Clarification, ByteDance cannot be China because they now have U.S. investors as well, some of which are very close to Donald Trump.
Jeff Yass.
Exactly.
Who owns 15%.
Does he want it to be sold to Elon Musk?
Well, does he want to see some value? And so we had Frank McCourt Jr., who has also got a bid, and he actually doesn't want the algorithm, which is an interesting point. But ultimately, if this is going to be worth 40 to 50 billion, which is what Bloomberg Intelligence thinks it could be worth, 30 to 50 billion, well, that would at least be some value going to the US investor base, which also includes General Catalyst, Sequoia, other key players have been in this. So I'm sure that if it was either a ban and they suddenly exit the US and they'll still have remaining money and value in ByteDance. Remember, they own shares in the parent company. And I've spoken to investors who are actually busily buying up ByteDance shares on the secondary market because they think, look, TikTok's going to grow like wildfire, whether it's in the United States or not. It's only got about 20% of its revenue coming from the US. It could just continue to scale elsewhere and leave US TikTok for dust.
So it's interesting that Trump tried to ban this.
Yeah.
And federal courts overturned that on free speech grounds. Now, I guess it's because of Jeff Yass's support, right? He's given at least $8 million to GOP congressional and gubernatorial candidates that Trump changed his opinion? Or is it that Barron said, I like TikTok, Dad?
Your guess is as good as mine, but also maybe it was, at the time, his rather general obvious loathing for Meta and for Mark Zuckerberg. Now, times have changed. Mark Zuckerberg has been doing an awful lot to try and align the business of Meta more in time with the next president and the White House. Look, he's just put Dana White on the board. We're seeing that they're removing some of their oversight of speech on the platform, certainly no more fact-checking. And so people might say that, look, with his presence in Mar-a-Lago of late. Maybe he's not quite so aggravated at all things Instagram, but that originally was Trump's issue, I think. And also TikTok, as he would say, helped him galvanize a young vote. And he likes TikTok, special place in his heart, as you would say.
The Mar-a-Lago effect on Meta is going to be something to behold as we watch the first 100 days.
That's an interesting segment in itself, because a lot of people around Zuckerberg say he already was bustling to break free of these sort of woke, liberal constraints. And this has just given him an excuse to do it.
And is it a fiduciary duty to align yourself with the next administration?
True,
is also the
true.
key argument.
Yeah.
Or patriotism. Anyways, Caroline, whatever you want to call it, right? For more on that story in Bloomberg Technology at 11 a.m. Eastern Time. There's a lot to break down for it. Now, coming up, deal making has been off to such a hard start in 2025. We're going to take a look at the M&A landscape next in today's Wall Street Beat. This is Bloomberg. Time now for the Wall Street Beat. Today we're looking at the fantastic work that our own deals team has been doing, because they've been breaking news left and right. We're going to talk about the deals that are coming through the pipeline. Joining us now, Bloomberg's Liana Baker leads the deals team here in the United States. We had J&J cross the finish line. Honeywell, huge. You know, when you kind of look at what's happening to start the year, what are people talking about most?
Well, it's funny. Honeywell didn't announce a deal yet. We're expecting that on earnings they could announce a big breakup, which is really the trend among industrial companies, but not all industrial companies. It's funny, you mentioned J&J. 2023, they did a break off of their consumer business, and that gives them the firepower to do deals like they did this week when they bought Intracellular, which makes drugs that treat mental illness and schizophrenia and other depressive disorders.
Yeah, when I saw Intracellular, I was thinking about telecoms, but then I read deeper into your story. And is it widely expected that you're going to see far more deals this year? Because there was one Bloomberg opinion writer, Chris Hughes, who said, hold on, not so fast. But everyone else that we've spoken to on this show says we're off to the races.
So it's been a great 2025 so far, but M&A is a momentum game. You have to look when deals get announced. Are the stocks of the acquirers going up? If we see that happen on every deal, especially with these all-stock transactions, that's a sign that boards and CEOs are going to get more comfortable with acquisitions. But it's too early to say we can sustain this momentum all year. But certainly it's been great for advisors and M&A reporters because there's so much to write about. And also the first few days of the year, we also saw things like Getty Images find a merger partner with Shutterstock. And that was interesting because those are in the same space. So if we're seeing companies say, okay, I'm going to merge with a company that I directly compete with, that could be a game changer.
You know, one thing I think is so interesting is that the spin-off index for Bloomberg has just been soaring. It's 88% higher than 52 weeks ago. Constellation Energy on the top of that list, GE, Vernova. If you see companies pursuing spinoffs doing this well, then are more activists just kind of knocking at the door right now and saying the spinoff strategy works? Time to get organized, time to get leaner.
It might work, but then you have to consider, are all the targets used up? How many more spinoffs could really happen before, you know, for something to move the needle? For Elliott Management, which has a lot of money, but they put a $5 billion position into Honeywell. There's not many companies that could, you know, garner these huge investments. So we'll be watching that, and there's definitely targets out there to look at.
All right, Liana, I guess we're going to be seeing a lot more of you this year, which is good news for us. Liana Baker there runs the deals team for Bloomberg News. Coming up in the next hour, Katie Greifeld is up and at 'em in San Francisco for the JP Morgan Healthcare Conference. She speaks with executives of GE Healthcare and Regeneron today. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is on assignment. And coming up, JP Morgan announces a leadership shakeup as earnings season kicks into full gear. Big Pharma also in the spotlight. Katie joins us from the JP Morgan Healthcare Conference with executives from GE Healthcare and Regeneron. Plus, the Los Angeles wildfires could result in losses of as much as $30 billion for insurers. We're going to get a live report from LA later this hour.
All right, let's take a look at what's going on in these markets. First off, the equity index is kind of treading water here with the S&P 500 up 0.1%, the Nasdaq up just a little bit more, but small gains, 8 points for the S&P, 33 points for the Nasdaq. The U.S. 10-year yield continues to rise, and we're looking at almost 480 on the 10-year yield. This is the level we were watching yesterday, but we're bouncing back up against it today as well.
Even with lower PPI than expected.
Yes, that's a really important point, because if we get a higher CPI reading tomorrow, if it comes in hot, it's going to be tough for the markets to deal, and you're going to see that yield shoot higher. I will point out that the VIX has not eclipsed 20 today, and that's one of the things you were talking about earlier. Yesterday we saw 22, so the market was getting very nervous, and today we're relatively calm. We're just not seeing a lot of movement.
But not a lot of movement. There is somewhere else where there's movement, and that is in the 210 curve. We're going to talk about that in just a second because bank earnings are kicking off tomorrow with JP Morgan, Wells Fargo, Goldman Sachs, Citigroup for tomorrow, Bank of America, Morgan Stanley the next day. It is going to be a rush. Joining us now, Erika Najarian, UBS equity research analyst for large cap banks and consumer finance. This 210 curve at 41 basis points is pretty. It looks good for the banks, but if you don't have that relief in interest rates that a lot of investors were expecting, what I start to wonder is, does credit quality start to deteriorate more? What will outweigh the other?
Yeah, so let's first talk about maybe demand for financing. So if there's a little bit of flatness between SOFR or the short end and the belly of the curve, I think a lot of companies may opt to essentially extend the duration of their debt rather than borrow from banks and go to the capital markets, which are wide open. So that might throw a little bit of water in the loan growth party for 2025. But from a credit perspective, you know, other than continued well-telegraphed challenges in certain parts of commercial real estate, I think what really matters more than interest rates is the health of the economy, right? The health of profits for companies. And I think that is way more important than where interest rates are for credit quality.
How much more NII can be squeezed out of the consumer, especially if you are JP Morgan or Bank of America? JP Morgan in particular, this is all credit card debt that we're talking about here.
There's not a lot of net interest income that can necessarily be squeezed out of credit card loans. But what can happen is that the base of that retail checking account is way more valuable in a higher rate environment. So a lot of us probably don't get any rates on our checking accounts, right? And so a lot of the big guys and potentially Capital One, as they close Discover, will be the juggernauts in retail checking. And so as you think about the repricing of fixed rate assets, retail checking deposits become more valuable. So it's not really about what you could extract from the loans that you give to customers. It's about the value of those deposits in the bank.
It's funny, I giggled a little because I was thinking the exact same thing when you asked that.
It weirds me out when we're on the same page.
I guess it's where the bulk it's where the bulk of the business is,
yeah,
right? When we see that yield curve finally come back up, this is where banks, the real banks, make money. It's not the sexier private credit stuff that we love to talk about, you know, making interest on leveraged loans, but it's the net interest margins that are so key, right?
It's so funny that everybody, maybe it's just because the bank stocks have come in, but everybody wants to be sort of a downer in banks. Like, guys, a steep curve is going to be awesome for the banks, especially those with great deposit bases. And exactly to your point, finally, it has been a decade plus since we've seen the value of these deposits, and we're finally going to get to see it this year.
Erika, what's your most contrarian view here? What do you think is not priced into the market?
So I feel like what's not priced into the market is how quickly the regulatory winds can change. So while we were all wrapping gifts and watching Love Actually, the Fed and the banks were very busy. So on December 23rd, the Fed essentially said, likely because of the Chevron case, that they were going to revisit the stress test, the 2025 stress test, and really make it more transparent. And then the banks sued them on December 24th, right? And essentially, they were saying, like, cool, like that you put this out, but we want to keep our legal rights. And we want to make sure we have like an emphasis and some take before the statute of limitations expires in February of 25. So this means to me that if we redefine excess capital by June of this year, then it's crazy that we're talking about like onesies and twosies and loan growth and net interest income. Because if we unlock this excess capital for both growth and buybacks, that is a massive difference.
What was amazing, you were gone that day, I think you were on vacation. We had Bruce Richards at Marathon telling us they're in conversations with banks all over the place trying to take that excess capital and lend to the private credit world so then they could keep going just more and more capacity here in markets to kind of really open up those credit markets.
That's the story we love. And I think bankers prefer Die Hard to Love Actually in terms of Christmas movies. But how much do you expect to see? I mean, Jamie Dimon said these bankers, even if they voted for Kamala, were dancing in the streets when Trump won, specifically or precisely because of that point that you're making. So how much more risky behavior do you expect to see in 2025?
I don't think that the banks are going to take any more risk. I just think they're going to have maybe proper capital ratios for the risk that they're already taking. So, for example, they can get even more competitive with great card offers to support the consumer, or commercial lending, and obviously supporting this great capital markets year in 2025. But also, there's so much excess capital that could return back to shareholders or be used for pretty good dividend growth.
Good point.
And speaking of, you have to wonder at this part of the cycle if people will get punished if they're not doing that capital return story at scale. I do, though, want to ask you about the story of the morning. What's happening at JP Morgan? This idea that Daniel Pinto will be retiring and Jennifer Pipsack will be rising, but she doesn't want to be CEO, at least not yet. So what does that mean for succession at JP Morgan? You are seeing the stock finally turn higher this morning after an initial dip on the news.
So look, I think that this is probably the best bench in banking, period, end of sentence. And the company has done a really great job at getting, these folks in front of everybody. And so whether it's Jen or Marianne Lake or somebody else, I think the investors are comfortable with who that next successor is going to be.
Who's the next CEO of JP Morgan?
So if I were a betting woman, I would say Marianne Lake.
Does she have?
I was saying the same thing, by the way, and Sonali and Shri were telling me, no, not likely.
Well,
she's been sidelined. She didn't get a promotion, and everyone else did.
They have been raising Jennifer Pipsack so aggressively in the last couple of years.
And look, she's awesome. And so I'm just really saying that because of her own announcement, the spokesperson announcement that she's taking herself out of the consideration for now. But either of those women are literally running like trillion-dollar banks on their own, whether it was the investment bank or the consumer bank. They're better qualified than a lot of folks out there that you could pull off the street, not internally. So I think either way, it's a win-win for JP.
All right, it's a really exciting sector, I have to say. And John Farrow, if he's not pumped about bank earnings,
I'm going to give him an earful tomorrow.
Yeah.
He has no idea what's coming.
We'll send Erika. We're going to send you to surveillance. Erika Najarian of UBS, thanks so much for joining us. Let's get a look at some of the stocks moving at this hour. For that, we bring back Bloomberg News' Denitsa Sikova. Denitsa, what are you looking at in terms of movers?
Yeah, let's start with Tesla. We saw a lot of optimism coming from Morgan Stanley. If we look at the base case, they say $430. But if you look at the bull case, they say $800, which is incredibly bullish target for the company. We've seen a lot of euphoria in the stock towards the end of the year. A lot of it was connected with post-election euphoria. We haven't seen that many upgrades in terms of fundamentals. But what Morgan Stanley has in mind is that they're going to turn a lot of their customers into continued subscribers, which obviously is going to bring a lot of revenue for the company. We're seeing a big boost today after a relatively shaky start of the year. So Tesla is doing quite well.
What about Palantir? Because that's another one where we've seen a very choppy trade lately after a ton of exuberance in 2024.
Yeah, so Palantir is up today, another strong day after a very, very rough patch. What we saw with Palantir is obviously was included in the Nasdaq 100, which we usually associate with a strong boost to the stock price. This is something we didn't see. Of course, we're coming from a very strong rally in 2024. The company was up 340%, but we're still seeing a lot of negative downgrades and when it comes to analysts, we're seeing from Jefferies a price target of $28 and underweight. Currently, the stock is around $68. So they suggest the price to be cut in half. So very bearish.
I got to point out, Bloomberg News is absolutely moving markets today with some of these scoops, right? The Trump tariff scoop, the dollar weaker on that, and then the possibility, China considering just the potential of selling TikTok to Elon Musk is moving markets in terms of Snapchat shares, right?
For sure. If you look at Snap, if you look at Meta, if you look at Pinterest, all of those stocks are down. We're going to focus on Snap just because that's the biggest loss today. As you may imagine, like the potential TikTok boost would be the biggest. We saw Friday that the stock was boosted so much when it seems that most likely TikTok will be banned. Obviously, today we have big news when it comes to the suggestion that potentially Elon Musk may be a good,
contingency plan.
Yes, a contingency plan. Yeah. We don't have any confirmation of that, but the reactions are already really big. And Morgan Stanley is saying that if, in fact, there is a ban on TikTok, there will be a lot of beneficiaries, and Meta is named as one, but also Snap. So everyone's watching, and those are the direct trades off of the news.
Denitsa, we thank you so much for joining us today. That is Bloomberg's Denitsa Sekova on all that's moving under the surface. And there's things moving in Washington as well. Coming up, we're going to talk about Pete Hegseth, Donald Trump's pick for defense secretary, appearing in front of the Senate today for his confirmation hearings for the president-elect's cabinet selections. That is just starting the week off. There are many more of them ahead. We're going to bring you the latest at what's going on at the hearing. This is Bloomberg.
Selected for leadership or promotion purely based on performance, readiness, and merit. Leaders at all levels will be held accountable, and warfighting and lethality and the readiness of the troops and their families will be our only focus. This has been my focus.
Let's get to high interest now. Look at what's making headlines around the world. Jennifer Piepszak will take over as Chief Operations Officer at JP Morgan after the bank's current president and CEO retires at the end of 2026. Piepszak, who is currently co-chief executive officer of the commercial and investment bank, says she doesn't want to be the CEO. Pinto, who's been with the company for more than 40 years, will continue to serve as vice chairman. The SEC has fined a number of Wall Street's top firms for failing to track their staff's business communications. Firms including Blackstone, KKR, Apollo, and Charles Schwab will have to pay over $63 million for not monitoring and archiving employee text messages for business purposes. The settlements are part of the SEC's ongoing crackdown on the use of unauthorized messaging apps. And traffic in the busiest section of Manhattan fell 7.5% during the first week of the city's congestion pricing plan. The data from the MTA shows travel times fell on most major crossings into Manhattan. The MTA hopes the plan will continue to reduce traffic even as driving picks up in the spring and summer months. Officials expect to release more details on the revenue collection data in the coming weeks. Sonali?
Now we got to go over to Capitol Hill because combat veteran and former Fox contributor Pete Hegseth is taking questions from the Senate Armed Services Committee as Trump's nominee to run the Pentagon. Nick Wadhams, Bloomberg's national security reporter, joins us now. Some of the things you're already seeing in terms of how this hearing is playing out has been expected, right? He was going to get some pushback from Democrats in particular. However, there have already been multiple protests at the hearings as well. And one question I have is, how do you expect some of the Republicans that have been on the fence, Nick, to be approaching the situation more publicly, perhaps? Say that like Joni Ernst.
All the indications we have so far are that Republicans are not going to oppose Pete Hegseth. You can expect some to ask some pretty tough questions and to interrogate his record. But so far, none of them have given any indication that they are going to be willing to defy President Trump. He's made clear that Hegseth's nomination is a priority for him, and he's going to want him to go through. So while there may be some Republicans who are not serving on the Senate Armed Services Committee who may be willing to oppose him folks like Susan Collins or Lisa Murkowski, we're not seeing any evidence so far that there's going to be a no vote from any of the members of the committee itself.
Nick, you cover national security for us. How important is this position right now as we see, hot wars in Israel, in Ukraine, and more of a kind of land grab mentality for the world powers?
I mean, there's no question that the Secretary of Defense is one of the president's most senior advisors. I mean, we have seen, to a large degree, influence and power being concentrated more and more in the White House, chiefly among the National Security Advisor and some of the other folks around presidents. That's particularly the case with Donald Trump, who in his first term did not, in a lot of cases, get along with his defense secretary. But at the same time, this is essentially one of the largest employers in the world. It has a budget of about $1 trillion a year, coming up on $900 billion in 2025. So, I mean, this is an absolutely crucial question. And the other one, of course, is, well, what happens at those times when the president is not available and he's tied up and there's an emergency overseas that requires an immediate response? Secretary of Defense often will play that role and be that decision maker. So you are looking for someone who has a degree of experience to be able to make those calls.
Nick, recalling the election and Donald Trump's statements that he would end the war in Ukraine before the inauguration, that he would get the hostages out of Gaza, at least at the very beginning of his second term in the White House. How likely are those two things to happen?
Well, on the Gaza ceasefire, it's looking increasingly likely. All sides are essentially saying that they are on the cusp of a deal. President Biden and President-elect Trump both saying in the last 24 hours that a deal is very, very close. We do have indications that there's a proposal on the table, and there are some expectations that you could see a deal within the next 24 hours. So that one's looking more and more likely, I'd say even imminent. Ukraine, on the other hand, you had the president moderate his language there a little bit. He said before the election that he'd solve it within 24 hours. Now he's saying he thinks it could take a lot longer, in part because you have the simple fact that President Vladimir Putin looks like he's simply unwilling to really negotiate or make any concessions. So one looks like it's certainly within reach. Ukraine, I would say, is a lot farther off.
What does this all say, especially because we are on the brink of that ceasefire, about how any potential strategy in the Middle East could change under a Trump administration?
It's a great question, because when you look at the policy proposals from the Trump folks and also from the Biden administration, in a lot of ways, there is not necessarily all that much difference. They've both made clear that they would continue weapons supplies to Israel. They still see Israel as the crucial ally in the Middle East, and that's not something they're going to be willing to give up on. Ramping up more pressure on Iran, for example, with more sanctions, and really keeping up the pressure on Hamas. The issue, of course, is that Trump has a better relationship with the Israeli Prime Minister, Bibi Netanyahu, and the likelihood there is that he could essentially force Netanyahu to make greater concessions. And in some ways, that does seem to be what's happening here, where you have Netanyahu in some ways making some concessions for this ceasefire because President Trump has essentially said, listen, I want this thing done before I get into office.
Nick, thanks so much for joining us out of Washington. Great to get your take as the team leader for national security. Nick Wadhams there talking to us through the Hegseth nomination hearings, confirmation hearings. You can continue to watch those hearings on your Bloomberg terminal. Just type LIV Go, and we have a live blog on that as well. You can type TLIV Go for the live blog. We are getting headlines across from Meta, the Facebook owner, saying it's planning to cut 5% of its lowest performers. This, according to a memo that Bloomberg's gotten access to, and they also expect to reach 10% attrition by the end of a performance cycle. I'm not sure exactly what a performance cycle is.
Sounds like Meta is acting like a bank. This is very typical of banking behavior.
I thought the exact same thing. When we talk about Bridgewater, for example, getting rid of 90 employees or 7%, and we were talking about that with Rebecca Patterson. She just said, you know what, this is what banks, this is what hedge funds do every year.
It is unfortunate, but it certainly happens. It also, by sending it a memo, puts people on notice that you have to be above that performance hurdle to make sure that you're keeping your job. Meta shares are lower on the day. They were already lower, I believe, before this news, but they are certainly still down by 1%. They're one of the few stocks in the Mag 7 up this year.
Yep.
I would also say 5% is like 3,600 workers. It is a sizable amount. They also say that they could reach 10% attrition by the end of a performance cycle. So looking to leave it lean.
All right, we'll continue to bring you news on this as we get it. We're going to come back with more on the markets. This is Bloomberg. Let's get a check on what's going on in these markets. You can see here from the equity indexes that we're looking at gains, and they're increasing. So we're near session highs with the S&P up 0.4%. The Nasdaq gaining about 0.5%. The 10-year yield at 4.79, not deterring equity investors. We're seeing some other interesting cross-asset moves, Sonali. The dollar is weaker today, and we see oil. Yesterday, we saw Brent crude get up over $80 and NYMEX at 77. Taking a little break.
You know, it's interesting. It's not just the direction of travel these days. It's the volatility under the surface with all these asset classes. If you don't know where equilibrium is, then how do you make a decision about where it stands?
The VIX right now at 1836. We're going to come back and head out to the JP Morgan Healthcare Conference. Katie Greifeld standing by with the CEO of GE Healthcare. Let's head now to the JP Morgan Healthcare Conference in San Francisco. Bloomberg's Katie Greifeld, our co-anchor, is standing by with a special guest. Katie?
Thank you, Matt. I'm here with the CEO of GE Healthcare, Peter Arduini. Peter, great to see you in person.
Katie, thank you for having me on.
Let's start with the news of this morning, and that is that GE Healthcare has signed a 7-year partnership with Sutter Health to provide AI-powered medical technology and software upgrades to the California nonprofit health system, expected to generate $1 billion in revenue over the life of this partnership. Talk to us a little bit more about this particular tie-up and whether we should expect to see more from you guys.
Yeah, no, well, thank you very much. You know, we're super excited to work with many of our customers and partners, but in this case with Sutter Health, as you may know, one of the largest systems in Northern California, but one of the top 10 in this country. And it's been a big focus of ours where we make lots of critical equipment that's used for diagnosis, services, training, and what we've been pivoting on is how do you integrate all of those to do what we call deliver precision care. And so just at this conference, you hear about all these new devices and drugs, many of the things that enable those we make. And so this relationship will really refresh all of their system. I think over 300 locales. They're opening outpatient centers all over. And the exciting part is for the 3.5–4 million patients that they take care of, they're going to have state-of-the-art equipment.
Let's talk a little bit more about the AI-powered piece, because we talk about AI from all angles, and the question we always ask is, what is the application? But you think about medical technology, it seems like that would be a bit of a natural fit.
Yeah, our industry is one of the industries I think that's really grasping it in all aspects of it. But from a GE Healthcare standpoint, we kind of think about it in 3 areas. The first part is kind of AI inside. So if you look at all of our products at this point coming out, there's some embedded AI in it, and that either means better productivity, you can get more scans or studies done, or it actually helps pinpoint or actually help a physician with the diagnosis. Those are the first two. The second area is in like a departmental. You think about labor and delivery department or radiology. How do you run it more effectively? In that case, it's about moving data for the right decisions. And then enterprise. We actually have a product called Command Center, which actually helps an institution manage the flow of patients. And I think this is, again, just the beginning of where this is happening. And this will be part of our relationship with Sutter as well.
I'm curious about the impact you see on the workforce. You know, as you know very well, there's a clinician shortage of sorts. How do you see these AI tools possibly changing the workforce when it comes to the health system?
Yeah, I think it's a couple. It's a great question. I think the first part is the more you can make these products automate many tasks that really are not value added, that's a first step. And, you know, we're doing that. Other companies are doing that. That says the precious time of the technologist or the nurse or the caregiver can be on those critical things that only a human really can make the difference on. I think those are the first steps. Broadly, though, these technologies are going to open it up to other users that typically haven't used the device because there's been too much expertise to enable them to actually use it. And so I think this labor shortage that we're feeling, and we play a part of helping training and development, but the tools themselves are going to actually make things more accessible to more users.
And I'm curious, I mean, do you think that you think about all the different areas that you touch, of course, at GE Healthcare, from ultrasounds to imaging, ventilators, diagnostics. Do you think that AI will ultimately touch all of those areas, infiltrate all of those areas? Or are there any certain sectors or parts of your business that you think will always be human?
Well, I think the beautiful thing about AI relative to this combo, I think, is this combination of the human touch factor of care, right? It is one-to-one patient-clinician relationship. I think AI is going to ultimately help free up more time to do that. And so when we think about, there's clearly in our portfolio modalities, as we call them, that will first be more effective because of the nature of it, but it'll evolve. So, I mean, a specific example, like I mentioned, is in MRI, the ability to actually change how the product makes an image, first time in 30, 40 years, which actually makes it go significantly faster. On the other side, all the patient monitoring in a hospital, all of that data today really isn't used. If you can actually predict, if you're actually in a hospital ward, you may need a nurse and actually call them before you actually have an issue. That's a significant improvement for that clinician taking care of you, and it frees up capacity. All those are different variations of how we think AI is going to help change care delivery for the better.
So this is a partnership that you signed with Sutter Health, and it sounds like some more. How are you balancing partnerships versus potential M&A? Because there is a lot of optimism when it comes to merger activity.
Yeah, I look, and we just had our investor day, Katie, a few months back, and we talked about M&A is going to be a very important part. We're excited about 2025 and beyond and the environment that we're seeing around the world. So tuck-in M&A for us makes a lot of sense. The breadth of the company we have lots of opportunities to, I'd say, fill out the solution for customers so that there's a better end-to-end capability. And then on the customer side, these type of relationships, we see more and more customers wanting to have not a relationship of a transactive one, but a real partnership where we're actually getting our hands dirty to help solve some of their challenges. And, we've done over 120 of these. It's been about $5 billion since we've spun out. But obviously this, as $1 billion by itself, represents, one of the largest that we've ever done.
Yeah, absolutely. Since spin-off, this partnership quite large. Let's talk a little bit more about your Investor Day. It was interesting. You take a look at the details. It seems like there was a lot of focus, of course, on the pharmaceutical diagnostic segment. I know that's your fastest growing segment, and a lot of focus on imaging agents, for example. How do you expect that market will change over the next 5 years or so?
Yeah, so one of the exciting things, and it's being discussed by a lot of pharmaceutical companies here at the conference, is this evolution of radiopharmaceuticals used in therapy. So we are a diagnostic company, not a therapy company, but these drugs that are arising, and they basically are a radioactive tracer that goes to a cancer cell, actually helps eliminate the cancer and doesn't hurt the good cells around it. We have the equipment that actually helps, what clinicians would say, see what you treat and treat what you see. And also a host of the diagnostic agents. One that we spoke at Investor Day is actually on the cardiology side called Flyrcado. And what it's used for is in a PET scanner to do cardiac perfusion. And it will replace products that have been used in older systems with higher specificity and sensitivity, which ultimately means a better diagnosis. And that's actually launching this March, April. So we're super excited about Flyrcado in this PET cardiology market area.
And Peter, I only have time for one more question, and I want to go to China, of course. You acknowledge that there's been weakness in China on your third quarter earnings call, and that's one of the lingering questions, I would say, over your stock, that China recovery. What is your viewpoint right now?
Yeah, well, first of all, I'd say overall, we're optimistic about 25 for the whole globe, I think, U.S., EU, a lot of things. China, I think my views haven't changed from what I've said at Investor Day, which is we're bullish on the future of China. It will be one of the largest, if not the largest, healthcare market in the world at some point down the road. We believe the first half is going to be a little bit more subdued as stimulus and some of the other programs they have get worked through. But we're optimistic that the second half of 2025 we start to see the recovery. And then 26, 27 beyond that, it gets back to a more normative rate of growth.
All right, Peter, that's a good place to leave it. Really appreciate you taking the time.
Thank you.
That is Peter Arduini. He is the CEO of GE Healthcare. Back to you, Sonali.
Katie, another great one. Looking forward to more conversations over there at JP Morgan Healthcare. Katie will be back in just a few minutes with Regeneron's Chief Scientific Officer. You're not going to want to miss that. Now coming up, California bracing for another round of dangerous fire conditions today. We're going to bring you the latest out of LA next. This is Bloomberg. Southern California is still struggling to contain the wildfires that broke out last week. Gusts are forecast to approach 70 miles per hour today, with the U.S. Weather Prediction Center warning of extremely critical fire weather conditions. Joining us now from Los Angeles, Bloomberg's LA Bureau Chief John Gittleson. Where do we begin? Because the reality here is not only is the state grappling from the damage that's already been done, it's very much still ongoing. So how are these fires going to be contained?
Really what we need is rain, basically, but winds picked up overnight and the red flag warning is expected to be in effect through Wednesday. The one thing that's happening now is there are an incredible number of firefighters and firefighting equipment in place, something like 15,000 people, plus all this aircraft. People have come in from around the western U.S., Canada, and even Mexico to help fight this blaze. But overnight, a couple of small fires broke out in Ventura County, northwest of Los Angeles. Relatively small fires, and they're able to attack them. But it just shows how things can spread because California hasn't had rain for more than 8 months.
John, I know you're
Southern California.
I know you're still really in the thick of it in terms of this fire, and getting it under control and stopped has to be task number one. But I'm just, mind-boggling how difficult it's going to be to get housing for these people and how long it's going to take and what it's going to do to the local economy. I mean, these bigger picture issues, what do you think is front of mind?
Yeah, definitely shelter housing is a huge issue. I mean, LA already had one of the tightest housing markets. There's only like about a 5% vacancy rate for apartments. More than half of people who are renters are rent burdened, which means they pay more than 30% of their income just for shelter. You need a $200,000 income to be able to buy the median priced home in LA. And now the market's even tighter and prices are going up, especially for rentals and especially near the fire areas.
John, we have to leave it there. We thank you so much for all of your reporting and for joining us this morning. That is Bloomberg's John Gittleson in LA. Now, coming up, we're going to head back to the JP Morgan Healthcare Conference up in San Francisco. Katie Greifeld is going to be speaking with Regeneron's Chief Scientific Officer next. This is Bloomberg.
Let's get a quick check on what's... Oh, sorry. Was that you?
I don't know. You,
my
me,
bad.
whatever.
My bad.
But yeah, let's get a check on these markets because, of course, we are off of session lows. I know you have been very excited about this rebound.
Yeah.
Very excited.
Well, not very excited, but I was in a dark place over the weekend after it looked like we have turned down from the 24% gain we saw in 2024. I'm looking all over the place, Sonali, not just at stocks right now, but there are a lot of other moves that I think are interesting.
And if you round up, the 10-year is at 4.8%. We'll look more at these markets later, but we're going to go now to the JP Morgan Healthcare Conference in San Francisco. Katie Greifeld standing by with another key guest, Chief Scientific Officer of Regeneron. Katie, take it away.
I'm sitting by with George Yancopoulos, of course, as you said, Chief Scientific Officer over at Regeneron. George, great to see you in person.
Good to see you.
So as you told me in the commercial break, you're the science guy. So we're going to talk about the pipeline here. And one of the big themes of this conference, in addition to M&A, of course, is weight loss. And you're testing 2 drugs right now in combination with Wegovy to improve the quality of weight loss, as I understand it. Talk to us about what that means and why that is important.
So everybody's excited about these new classes of weight loss drugs that really can have a big impact, drop a lot of weight. The problem that's not quite as widely appreciated, but is increasingly recognized, is a lot of that weight loss, unfortunately, is muscle. 30 to 40%. So if you lose, for example, 30 pounds, 12, 13 of that could be muscle. That's devastating. I mean, I've been working out my whole life. I've never put on 12 pounds of muscle. If I were to lose that, I would be, very much affected. So what we're hoping to do is we've developed muscle preservation agents that we've actually shown can grow muscle in other settings in human beings. And for the first time now, we're combining them with these weight loss agents to see whether we can prevent that muscle loss or even increase it. So after you lose the weight, you've maintained your muscle or maybe even gotten stronger. That also is important from the disease aspect, because in a lot of the diseases, muscle is what controls insulin and controls diabetes and so forth. So if you lose weight but you're losing muscle, you may not have as good an effect on all these other metabolic associated diseases like diabetes. Right. This could really help there. So the other reason why it could be so important is we now know from how these drugs are used in the real world. In clinical trials, people stay on them throughout the whole period, 3-4 years. But in the real world, they're cycling on and off them. Less than a third of the people are staying on for longer than a year. You regain all your weight, all as fat, okay? And then you go back on, you lose it as muscle, you regain it. So over time, this could be devastating to some individuals, especially older people who are already suffering from decreasing muscle mass. So this could really make an impact on creating better quality weight loss, resulting in healthier people, not only resulting in pure fat loss, which is what you want to lose, but leaving you stronger, but also more metabolically fit.
Right, and great context on why muscle, of course, is important. It's not just about looking buff. You need it for the metabolic implications as well. But I want to talk about the practicality here. So you would be having muscle-boosting drugs that you're taking on top of the weight loss drug. Is that correct?
So that's what we're testing in our original clinical trial, because we have multiple muscle preservation agents, and we see which ones and how they're going to do. Once we know if there is magic combination that works the best, we can make what we already have in the labs, what we call unimolecular solutions, which will then advance to clinical trials. And those will be one treatment that will be a combination of what we would hope would be the magic combination.
And you think about the competitive...
And by the way, our approach is there. Our unimolecular solutions are designed to be given once a month. The current drugs are given once a week. So not only would you maybe get better quality weight loss, better metabolic effects, but once a month instead of having to take a shot much more frequently.
I want to get your thoughts on the competitive landscape, because you're testing this with Wegovy, of course, of Novo Nordisk, but you have Eli Lilly also looking to tackle this muscle loss problem as well. Why do you think that your approach is different and better? Well,
our approaches are very related. Indirectly, their efforts that they acquired from the outside indirectly came from our science and from our efforts. It's very interrelated. The only difference is that we break the muscle preservation approach to multiple different components. They have one approach that just tests blocking all of these related factors. We block them one at a time. So if there's one that's more important than the other, but it's safer, we'll be able to pick the safer one. They won't have the ability to separate because they have an all-in-one approach.
And where are you in these trials? When can we expect to see this data?
Yeah, so what we announced, our trials are fully enrolled, and by about the middle of this year, we should have data.
All right, middle of this year. We will be in touch on that. But let's talk a little bit about, of course, the pipeline where you spend your time. Do you think that there are any opportunities for inorganic growth here? Could you look to M&A to sort of bolster the pipeline, or are you looking to keep it in-house at this point?
So remember, we're the company that invents and develops its own drugs. We're the true unicorn in the industry. Most people can't do that. They don't have that ability, so they go to the outside. We have such a rich pipeline. We have 40 to 50 exciting programs in clinical trials already to cure allergy, to cure various forms of cancer, not only one cancer. Some of them are the most exciting anti-cancer agents that have ever been described. We're working in a variety of related fields, preventing clot formation, and the list goes on and on. So we don't need to go outside for individual assets. If we are so lucky as to find one magically, we might take it. But what we do, unlike most other companies, is we make tech collaborations where we see companies that we consider younger versions of ourselves. We're the leading actual technology, biotechnology company in the world. We're looking for younger versions of ourselves that are doing something that's synergistic with us. So, for example, we started a partnership, not to acquire products, but a technical collaboration with a great company called Alnylam, another one with a great company called CRISPR. So together with them, we're bringing some of the most exciting new gene medicines forward to patients. In one case, gene silencing approaches, novel gene silencing approaches. Another, the first phase 3 programs with CRISPR. Everybody talks about CRISPR. We're the ones who are bringing them to actual patients. Right. So when we go to the outside, we look for things that can be synergistic with other great technology companies. So for example, with Alnylam, we have some exciting programs that I think could make a real difference, totally new approaches to Alzheimer's. With Intellia, we're actually doing the first in vivo knockouts of genes in humans to correct diseases, which could be addressed with genetic approaches.
Right.
And so genetics approach is a really important new thing for us. One thing that we showed incredible data, perhaps the greatest gene therapy story ever. We took genetically deaf children, and with a single treatment, we were able to restore hearing in 10 out of the 11 ears that were treated, which is really miraculous. So that's what we're about. We're about developing our own science and technology, or finding very related companies whose science is very synergistic with us, and creating new breakthroughs that have never been done before. Right. And we have a history of bringing more firsts to patients, making bigger impact on diseases than almost anybody else.
George, it feels like we're just getting started, but I am up against the clock here. So thank you for your time today. That, of course, is George Yancopoulos. He is the Chief Scientific Officer at Regeneron. Back to you guys.
Katie, thanks very much. Katie Greifeld out there in San Francisco. She's going to have more interviews from the JP Morgan Healthcare Conference throughout the day, including the CEO of Illumina, which put out a press release yesterday that it was going to work with NVIDIA, which is probably a good idea for a healthcare company to do. We are looking at markets, Sonali, that continue to rebound. We saw a recovery yesterday into the green, and we're up again today at session highs.
The day is long. You are still seeing yields higher even after that PPI data. Quickly, the attention is going to turn to earnings and CPI data. Inflation is going to be right back in focus once again, Matt.
All right, so we do see actually, we're giving up some of those gains, the NASDAQ 100.
Almost
only
all of them.
0.06 of 1%. As the 10-year yield, as you point out, approaches 480, we'll see what happens with the CPI data tomorrow. Also on Open Interest tomorrow, Carol Schleif of BMO joins us, Sarah Hunt of Alpine Saxon Woods, Meb Faber of Cambria Investment Management, and Hamilton Lane co-CEO Eric Hirsch. This is Bloomberg.